Conflicting views over the pound-dollar market sets the tones for uncertainties in trend directions as technical indicators remain bullish on the pound, yet the underlying fundamental recommends that the bear is gaining traction. Short-term technical indicators are pound buyers, while on the fundamental front, the softening UK economic releases can hinder the Bank of England decision to hike rate as market anticipated a hawkish Bank of England. Good morning, everybody. Today is Monday, and January 2014, and this is your Forex market commentary brought to you by REAL ECN. In line with today's discussion, we're going to look at the pound-dollar market. First of all, we're going to explore the technical front on the pound-dollar market. The pound-dollar market recovered all the losses from last week's trading session after dropping to session's low at 1.6380 level before bouncing back and closing the session higher at 1.6500 level. Pound sterling's opened today's Sydney trading session at 1.648. The dramatic rise seen in pound selling pressure can be attributed to anticipation of higher US non-farm payroll, which in fact turned out to be a disappointment and causes the market to jump back into the long pound positions. The pound-dollar market can be characterized as not highly sensitive to strong fundamental theme like that seen in the euro-dollar market. In terms of risk aversion or tapering actions, the technical market recently observed a lower swing high as the sterling may possibly enter a ranging trend zone with potential window for reversal development to take hold. The disappointing US non-farm payroll has given the sterling the momentum to close last week higher against the greenback, ticking up 0.39%. Hourly chart established the Fibonacci resistance for pound-dollar market at 1.6489 and support at 1.6475. This week on the economic calendar, on Tuesday we have the UK CPI releases, with expectation of 2.1% year-on-year, in line with prior. Also on Tuesday we have the UK core retail sales releases of 0.4% month-on-month of forecast in line with prior. On Thursday, we have the US core CPI forecast of 1.1% in line with prior. Also, we have the Federal Reserve meeting and the release of Fed minutes. On Friday, wrapping up the week, we have the UK retail sales month-on-month with a forecast of 0.4% and prior of 0.3%. A collection of technical indicators on the hourly chart interval on the pound-dollar market suggests a temporary bullish market sentiment and recommend short position on the greenbacks. So now let's have a look at the technical indicators. So here we have an hourly time interval. First in line we have the RSI, which is a relative strength index. It is a momentum oscillators, and right now it has a price value of 52.745 with the technical recommendation of a neutral. So moving down two notches, we have MACD, which is moving average conversion divergent. Now we have the 12 days EMA sitting above the 26 days EMA with price value of 0.001. Technical recommendation on the pound is a buy. So moving down to CCI, which is commodity channel index, it confirms the buy or sell signal and also measure momentum as well. Right now it's sitting as minus 58.60. Technical recommendation of a buy. So lastly, we're going to look at their bull to bear power ratio. Even though the ratio is not strong yet, the bull still overpowered the bear with a positive ratio of 0.0023 with technical recommendation of a buy. In total, we have a technical consensus of a buy backed up by 7 buys, 1 sell, and 2 neutrals. Now let's discuss the fundamental fronts. Last Friday release of US non-farm payroll data had been perceived by the market as a disappointing miss below expectation. However, this can prove positive for risk trend as disappointing US non-farm payroll data can signal to the market that the extension of stimulus program is justified under these circumstances. The US Labor Department added only 74,000 jobs when analyst consensus expect an addition of 160,000 jobs. Also released along with the US non-farm payroll on Friday is the unemployment rate, which ticked lower and beats economists' expectation of a 7%, it's now sitting at 6.7%. This in itself is gathering markets' attention since the target unemployment rate of 6.5% is part of the Fed's mandate in discussing possible rate hike. So what does this present? This presents itself as a mixed picture coming out from Friday's data release, which sets the tone for the greenback speculation looking forward. Last week, risk event data coming from the UK has fallen below market consensus, with the UK's PMI service reading came out at 58.8, just under expectation of a 60.3 reading. What this implies is that even though the reading sits above 50, it is still in the growth territory. Reading that fall below expectation signal to the market that the pace or the rate of growth may be slowing down, and this could largely be attributed to a higher sterling strength seen in recent months that could possibly affect the UK's export market. Both November's industrial and production readings fell below economists' estimates. One important event that occurs in the market right now is the drop in UK's gilt yield across the board from a 5 years gilt dropping 8.6 basis points to a 10-year gilt dropping 15 basis points since the beginning of 2014. Speculators have been drawing parallel between the flattening in US yield curve from September to October of 2013 with a US dollar weakness. So this begs the question, could this hint the beginning of a sterling weakness as the market anticipate the pound momentum begin to lose steam? As part of the Bank of England forward guidance policy, it remains accommodative and continue to keep interest rate low if other economic component, which is inflation data, is in line with the bank's target or sitting below the target. This coming Tuesday CPI release will have an impact on sterling speculation. Market consensus anticipate a 2.2 year-on-year inflation reading, sitting below the Bank of England target of 2.5% before changing the infrastructure of forward guidance policy. The expectation of a softer CPI environment has the market pricing in a dovish undertone that underpinned the Bank of England next meeting in February. If this dovish view does materialize, this could profoundly change market sentiment towards the pound and cap any future rally.